I think if you look at the last couple of years, the opening of China and the increased accessibility of the Chinese bond market for foreign investors has been the big topic ever since the PBOC announced their intention to open the market back in early 2016. And what the good thing about that is what you've seen is that the PBOC is really committed to making it work. So every year we've seen the regulator in China announcing new measures to make access for foreign investors easier, more efficient, and to remove a lot of the operational inefficiencies that existed in the early stages of the program. And if you look at what happened last year from an investor perspective, you can clearly see that investments in China and foreign investors have picked up significantly for most of the year. And I think that's a lot of this is as a result of the opening and the additional measurements that China put in place. I think towards the end of the year, these investments sort of tailed off, and I think a lot of this is down to the fact that you had all the talks about the trade war, you had an increased FX volatility coming from uncertainty about the exact state of the Chinese economy, and so it felt like there was a bit of a lull in investor sentiment. The good news there is that earlier this year, I think there was an announcement about the inclusion of China in some of the big global benchmarks from bond perspective. MSCI has announced their intention to increase the share of China equities in some of their indices. And so I think the market sentiment has changed again, and certainly we've seen a lot more inquiries from clients over the last 4 to 6 weeks on China than we did maybe in the last quarter of last year. So, and I think if you look at those trends, the index inclusion, that will obviously drive a lot of interest. But all of this is also self-reinforcing, and you get to the point where more and more investors are likely to consider China a core part of their asset allocation. And so I think we're going to continue to see a lot of interest in China. At the same time, when we look at our clients in Asia, in Europe and the US, we also see that they're at a very different stage in their thought process. So if you speak to asset managers, insurance companies in Hong Kong and Singapore, you'll see that they've already invested in China, and for them it's a question about potentially increasing their allocations or going beyond government bonds into corporate bonds and looking at availing themselves of the full investment opportunities in the Chinese market. If you go further away from Asia into Europe, you'll see that many of the investors are at a much earlier stage. They're considering maybe their first investments into China. They're still working out how it exactly works operationally in terms of how to set up their funds, how to access. And the US is potentially even slightly further behind. And so we can see that there are going to be very different drivers in terms of where the investment in China is coming from, with a lot of the Asian investors looking to go beyond their initial allocations, whereas a lot of the investments from Europe and the US is likely to be more first-time investments, more tentative. Looking at Asia from an ETF perspective, you can see that the size of the total ETF market in Asia is a small fraction of what it is in Europe and the US. And it's been like that for years. And so some people say that, it's so small, that needs to be able to grow fast. If you look at what ETFs have done in Europe and the US, at the same time, it's not happening. And a lot of that is due to, I think, challenges that are there in terms of, for instance, the distribution channels here not being quite as developed, let's say, as in Europe and the US. So you don't have that many robo-advisors, which are big drivers of flows into the ETFs in the US market. You tend to have much smaller markets, but you have one big US market. But in Asia, you have Singapore, Hong Kong, Malaysia, China, and they're all slightly different. They all have different access channels. So it's generally harder, I think, to get large, big ETFs to be established in the market. And I don't see any of that changing in the near future. You have a couple of bright spots on the map in terms of ETF developments, but they also tend to have very, very unique causes, like for instance in Japan, where the Bank of Japan is just a big investor in equity ETFs, and that just drives overall ETF growth, but it doesn't really diversify the investor base or is a good proxy for how investors in general think about the ETF market. Or in Taiwan, you had a big growth in the fixed income ETFs over the last year and a half, but it's mainly driven by life insurance companies, again, very, very specific and not really replicable across the whole region. One of the areas where we see there's going to be some developments this year is that certainly if you look at how ETFs are being used in Europe and the US, it's not just an investment vehicle for an individual investor or for investing your money for the long term. But over time, as ETFs have grown in size and shape, they've really become an investment tool and part of the ecosystem that goes beyond just investing in a specific ETF. So if we look at how market makers look at ETFs in Europe and the US, they're trading the bonds and they're trading the ETFs as a complement. On top of the ETFs, you have derivatives like total return swaps or the CDS indices. And that together just makes for a much wider use case for ETFs, because all of a sudden they become a tool in the investment process rather than just an investment decision in itself. Now, if you look at the derivatives market in Asia, again, it's much smaller than in the US and Europe for pretty much the same reason. But one of the developments there is I think we're going to see more tradable instruments from a derivative side, synthetic instruments coming to the market later this year. And if you look at Europe and the US, it's been the ETFs that really have supported liquidity in things like the total return swaps or other derivatives in the indices. And maybe in Asia we can do it the other way around. We can have the TRS helping the ETF market to establish itself and become bigger, because obviously with a TRS you sort of have a core constituency that will help build AUM, build a core investor base for the ETF. So we're looking forward to see if maybe that can kickstart some of the faster AUM growth or bigger ETFs here in region. Because I think everyone you speak to on the street agrees that if we had bigger and more ETFs, they would be more useful and would be used by more people. And I think that's ultimately the goal for everyone in the marketplace.